My name is Matt Sitter. I'm CEO of AFN. Really excited to have you all here today. At AFN, our fundamental belief is that change is where opportunity happens. And the best way to find opportunity in change is a network that is diverse in experience, expertise, and perspective. So with our conversations that we have, we bring subject matter experts in to help us understand more about what's going on in the world, but also we want to make sure that interactivity can happen so we can learn more from them more directly. Today, we're talking about current state of private equity. We've got Victor Masaya, managing partner of Presidio Partners, middle market PE firm focused on tech, media, and financial services. When we think about what's going on in the world, we have a lot of inflation that's been happening. Hopefully that's tamping down a bit, but we've got interest rates that have changed. We got still in flux work environment, all these different things that are going on. Victor, welcome. I'm excited to hear what you're saying about what's going on in the world of private equity today. So do you want to give us a little primer on some of the things that are top of mind for you?
Yeah, no, glad to be here. I'm not sure if I mentioned this last time, but these are certainly even more interesting times, than last time we had caught up. It's unique in a lot of ways, especially for our CEOs. But if you take a step back from a deal standpoint, especially during Q4, just given all of the volatility in the market and all the uncertainty in the macroeconomy, deal flow was pretty slow, particularly because the financing markets weren't really there. Certainly, banks were re-upping with existing clients or portfolio companies of private equity firms because I already knew the credit. But for new opportunities, it became a bit more challenging. And in Q1, unfortunately, starting to see almost a similar pattern. Entrepreneurs and owners really haven't pulled the trigger yet on committing to a sale process. So the volume is still down. I mean, ultimately, we'll see where Q1 ends up, but it is still feeling a little light out there. From conversations with a number of investment bankers across different sectors, they're basically seeing the same thing. So, within private equity, I'd say deal flow remains slow. Operators are spending a lot of time just trying to deal with all the changes in the respective industries, macroeconomy, work from home, recruiting. So to an extent, certainly putting out fires depending on which industry you're in. From a macro perspective, obviously the GDP is what it is, and we've seen some upticks. We've seen inflation start to slow down, and it almost feels like this is going to be a sector-specific recession. We've got, business that's tied to real estate, and they're certainly getting, lack of a better term, they're just getting hammered. There's been layoffs across the board. Big tech obviously hired quite a bit of folks during COVID, and so we're starting to see the results of that. And now there's more of an emphasis on cash flow, and they've got other sectors where it's been relatively stable. So I think it's really industry specific these days when it comes to the economy.
Where do you think where are those industries that seem more stable? What would you call out as those?
Yeah, so we have parts of media. I mean, I know Spotify laid off some folks, but we've got a business in the audiobook space, and subscribers continue to increase. So listening does as well. We've seen the number of books that we're publishing grow rapidly year over year over the past, I'd say, 3 to 5 years. Our largest competitor in the space is seeing the same trends. So certainly within parts of media, there continues to be some growth and some stability. So again, it really depends on what space you're in these days.
I thought people were just listening to podcasts now. I didn't think that.
Well, they are, but Spotify's not making a whole lot of money on them.
Yeah,
And so, but I mean, I guess when you plow in hundreds or billions of dollars into an unproven model, unfortunately, that's kind of what happens.
sure, sure. I mean, one of the things that you hear about in the news is that there's still a lot of dry powder that's sitting out there,
Yep.
and that people are waiting for, more to shake out. How true do you feel like that is?
So I think it's very, very accurate. So in Q4, we did see some attractive deals. The issue is because of the amount of dry powder that is more anecdotal from what we've seen, but also from bankers. When there's a good deal out there, you get a lot of interest, and so the price ends up being driven up um, because these people, including us, we're going to get paid on how much money we put to work ultimately. At a certain point, and depending on the way your fund is structured, for us, we get paid on paid management fees on committed capital, but ultimately it flips to invested capital after the end of your investment period, and so there is some pressure to put money to work, and we're certainly not alone. And in Q1, we're seeing the same thing for the deals that do look attractive. We're getting priced out because folks are being very aggressive because of the dry powder out there.
Okay, so things that could have been good deals are turning into less good deals because there's a lot of competition for those.
Yeah, so firms are avoiding deals where there's much more risk, whether it's customer concentration, or whether an industry is tied to interest rates, such as specialty finance, a sector that we play in. But for businesses that have, and this is kind of typical private equity, for businesses with a lot of high visibility, recurring revenue, those continue to be priced pretty aggressively.
One of the phrases that I've heard recently, which I wanted to check by you, is that in venture capital, it's much more of they're doing hunches, whereas in private equity, it's much more of a thesis or a formula. I wanted to see how that jibes with how you see things.
I can't speak a whole lot about venture capital. I've got my own opinions.
Yeah.
Yeah, but in private equity, I mean, yeah, because venture, obviously, it's you just got to be able to look out farther. I would be a terrible venture capitalist, especially within lower middle market and middle market. We spend a lot of time on modeling and projecting cash flows because ultimately, especially for us, when we sell into larger private equity or strategics, a lot of it's really going to be predicated on demonstrated growth of the business, as well as cash flows and how sustainable they are and how much visibility you create. So for us, we certainly spend a good amount of time on macro and can be thematic at some time, at points in time. But for us, whether it's an industry that's cyclical or not, we just really want to invest in good solid businesses that can withstand different business cycles. As an example, we've got a business in the chip design space for automated test equipment of semiconductor chips, and we're not focusing necessarily on the right time to sell because it is a cyclical industry. And so what we really want to make sure of is, what is the baseline? How is this business going to perform during up and down cycles? And what do those cash flows look like? And how do we grow the business? And so during a down cycle, we're certainly willing to invest more into the business because we think over the long term, the semiconductor industry will continue to grow. So it's sort of more science with some art mixed in.
Sure. Sure. What's the time horizon that you guys typically look at?
It's well, like others, we'll model 5 years,
Okay.
but we'll be opportunistic if there's an interested strategic or even private equity within after a few years. And then at times, because the businesses that we're growing in that we're investing in are smaller, it could be a 7 year hold as well. So
Okay.
it really just depends.
Gotcha.
Um, yeah, there is a level of institutionalization for the businesses that we invest in. Setting up a formal board, independent board members as well, and so just want to make sure that we have the right governance in place, as well as formalizing processes and procedures internally, so that for the next buyer, there's less risk there for them.
Right, right. Okay. So a lot of what you're doing is just making sure the flywheel can
Yep.
continue to turn and that you're getting more leverage out
Yeah,
of those processes.
absolutely.
Um, you've got investors for your business, and who are asking you to put capital to work. Have the pressures that they're putting on you, or what the questions they're asking, have they changed at all over the last year?
Yes and no. For some, they've got, thankfully our portfolio has performed. They've got other fires to put out. For others, there's a lot of LPs want to put more sort of processes in place and more frequent check-ins. At the same time, they realize that we've got a job to do.
Yeah.
And so with some of our investors, we've made available management teams so that they can get a better sense and a better sort of feel for the businesses and how they're performing, just to give them that additional level of comfort, just given all of the volatility. And we've got investors in the US, we've also got investors in Europe. And just given what we're seeing globally, it's really just going to depend on their existing portfolio of managers that they invest in,
Right.
and some of the issues that they're coming across as well in their respective regions.
Sure.
So
Sure.
it's a mix.
Okay. Okay. So when we think about your interactions with, some of the operating companies that are out there, transaction flow is slower, as you mentioned. Is the research and operations engine, is that still going at the same clip? Is there the same level of looking at things that you saw prior to the interest rate changes that we're seeing now?
Yeah, there's certainly a lot more diligence. It's a lot deeper diligence. I'd say it's a deeper level. And so what that means is things just take longer to get done. It's a lot easier to come up with a price in a zero interest rate environment. Not that folks would assume that would hold, because ultimately we do look out 5 years, and we'll have a certain view on what the economy could look like in 5 years, and so we do bake that in. But it is easier to get comfortable, when markets do continue to climb. And so it's really, I'd say you're spending more and more time, for instance, on doing diligence on the customers of these companies that we're looking at, and then also their respective suppliers and labor force. It's almost that extra. It's that additional layer. We certainly do it we do customer calls. We Depending on how big of a customer they are, we might do a visit with them as well, as if the portfolio company is okay with it. But I'd say we're doing even more now at this point.
Okay. And so, someone who's going through one of these due diligence processes, they've got the firm who's looking to invest in them, going out on a customer diligence visit. What happens on those? Can you demystify that a little bit for our CEOs?
Yes, again, it depends. So you'll have firms that are a lot more, and again, it's also dependent on the size of the business.
Okay.
So and the firms that are attracted. So if it's a strategic discussion, the operators will probably have a better sense of that than we will. Companies will come in, try to understand, what some of the secret sauce is, also key employees, also, what some of the potential synergies are. That's what we do when we're on the buy side with our portfolio companies looking to make a tuck-in acquisition.
Okay.
When it's a private equity firm coming in, you'll get all sorts of flavors. You'll have some similar to us that are really more operationally focused.
Okay.
We get the numbers, we'll run our models, we'll certainly have sessions with the CFO and anyone else
Okay.
pertinent to talk about cash flows, working capital. But the main parts of the meeting are really focused on the operations themselves and just trying to get a better sense of what can and can't be improved.
Okay.
So with a lot of the businesses that we look at, these are businesses that are somewhat constrained by capital because they're backed by owner entrepreneurs, friends and family, and so there's just a lot. There's a lot more that they could do if they had additional resources and additional financing, and so we spent a lot of time trying to examine that because ultimately for us, these businesses have to perform and have to grow. So it's really just getting an understanding of that. And then certainly we'll have a segment of the management presentation or the meeting with the team, understanding what some of the downside protection is. So who are the big customers? Are they under contract? What's the likelihood that they may go work with a competitor at some point? How solid is your budget for this upcoming
Yeah.
year as well as for the next year? Because for us, we're not going to have very many 10 baggers. It's really some doubles, triples, and a handful smaller amount of home runs. And
Okay.
so we need to make sure that downside protection is there and that we're not losing
Yeah.
capital on any investment.
When you're going in on a customer visit, who are you hoping to meet with? Is it, the person who's actually buying the product or service from the folks? Who are you looking to talk to?
So for us, who we're allowed to speak with in the first meeting tells us a lot.
Okay. Yeah.
We'll and this might be helpful for folks. So we'll indicate, we'll send out an agenda. We'll tell everyone what we want to talk about, including their advisor if they have one. Most of the time, with the businesses that we invest in, there is some form of a broker or an investment banker. And depending on who they bring into the meeting, that immediately will tell us something.
Okay.
So we have had times where it's only the CEO, which is not great because it tells us that there's not a whole lot of depth there, or that there's information that they don't want to be shared.
Right.
And if it's only a couple people, that's probably okay. Oftentimes we'll see the CEO and the CFO upon a first visit. But ideally, we'll also have somebody within sales as well, because that's obviously important. Business development. Ideally, there'd be a team that demonstrates the bench internally,
Okay.
because with a lot of businesses that we look at, the owner is heavily involved in all facets of the business, which is not great for scaling. It could be okay, and certainly a way to start a business and to grow from ground up. But we want to see a deeper bench behind the CEO. And then another factor that we certainly judge is the interaction between management.
Okay.
Is there genuine chemistry that we see there? Is everyone allowed to provide their own answers, or are they getting cut off by the
Okay.
CEO? So it actually that interaction actually tells us quite a bit.
Okay. And when you're looking at that interaction, is that's all qualitative? You're saying like,
Oh yeah,
okay, this
absolutely.
is
I
what
mean,
I
we can't.
observed.
Yep. So after the meeting, we'll all share our own thoughts. There's certainly a lot of similarities, but people have different views on body language within the room, and so we just talk about it as a group. And then another important factor is really for us, we want to spend as much time with management as we can, but in a very efficient manner. So we'll have a management meeting. We'll also have either lunch or dinner, where hopefully we can glean more information,
Okay.
especially in a more relaxed environment.
Get them out of the office so that, you can know them a little bit more deeply.
Yeah. Because for us, what's important, and I'm sure similar to other private equity firms, especially those more focused operationally, is really trying to understand if you can establish a rapport with these folks. Because ultimately, for us, it's our cadence is such that when we first make an investment, we're interacting every couple of weeks, and then hopefully as time goes on, it's once a month. But there's certainly a good amount of interaction between a portfolio company CEO, CFO, as well as us, and it really needs to work both ways. If it's just passive capital that folks are interested in, we're not the right partner. But if they're looking for a partner to bounce various ideas off of and open to recommendations, then it could be a much better fit.
Cool. And so when we're thinking about, you said you're doing deeper diligence right now on companies in a variety of different ways. Does that equate to fewer companies that you are looking at a given time?
No, I mean we still have obligations to our LPs, and we're fiduciaries. So we're still looking at the same amount of. We're trying to look at the same amount of deals. It's really
Okay.
a function of the environment. So, with deal flow, what it is these days, I'd say relative to Q4, our pipeline's getting a lot deeper. Relative to a year ago, it's probably still not there yet. But we've got folks that also want to co-invest alongside of us, and so we want to make sure we've got a strong pipeline behind us. And I'd say when it comes to diligence, because yes, we are taking that extra step, but at the same time, if we get a sense that this is not going to be a deal that's going to close for various factors, we're probably walking away sooner.
Okay. You want to get to that decision point quicker now.
Yeah.
Okay. So particularly in a very low interest rate environment, I would say many of our CEOs were hearing from PE firms like all the time, right?
Yep.
The analysts reach out and, saying, oh yeah, we'd love to meet with you, talk to you, all that stuff. Would you say that that's happening less right now, or do you think that pace is still there where people are being contacted, but it's just a lot less likely to go to the second step?
Yeah, I mean, you still have, depending on the firm, there's firms that have folks that are dedicated to reaching out to portfolio companies, and it's not, if you can find the right deal, at the right price, it could be a great time to invest. If you look historically during down markets, a lot of returns have been generated from deals, made during sort of closer to recessionary times. So I think folks are still being proactive. It's just it's more subject now to financing than it was in the past, because firms have various amounts of leverage that they want to put in, but ultimately they've still got to put capital to work. So they're still going to be doing the same amount of work. It's just how quickly is velocity going to be the same ultimately.
Okay. So getting out your crystal ball, which is foggy for all of us. But is there
Yeah.
any particular sector that you're a little bit more excited about than another in terms of where it's going to go in the near term?
So, just I'm gonna have to limit it to the sectors that we focus on. That's where we spend the most time. Financial services with the interest rate environment, that's certainly going to be a bit more challenging because the with the deals that we look at, the owners will probably be less likely to transact at this point, and we'll want to get a better sense of when the rates will stop. Obviously, there's projections out there. Maybe the Fed will raise a couple more times at 25 bips, but and maybe that's priced in, maybe it's not. But there's going to be some hesitancy there within media, especially with our audiobooks company. We continue to be bullish in that segment of the market. And if the frothiness of the public markets has been reduced, then there may be opportunities where previously we couldn't get there based off of valuation. But in this climate, there might be more interesting opportunities at a price that we can get comfortable with. So we're certainly spending more time within the media space, and then within technology, you can almost lump in everything into technology
Sure.
these days. So we'll continue to spend a lot of time within any form of technology enabled services, whether it's for business or consumer. We're not going to be out there investing in the latest AI platform or anything like that. But certainly businesses that have at least been flat or maybe down a little bit during recessionary times will still be very interesting to us.
Gotcha. And we'll go into questions from our audience in a minute, but I would say, is there anything out there that you're like, hey, I'm not touching that thing with the 10-foot pole right now? What industries would you say like, hey, you got to be really, really feeling something if you're going to invest in them?
I'd say anything tied to some parts of consumer products.
Okay.
To be very audiobooks and media, we could get comfortable with, but other forms of consumer products, whether it's food and beverage or retail, it's just going to be very challenging for us. Just given this inflationary environment, you still got the Great Resignation, which we still don't quite understand. Companies that have exposure to those segments of the market is just going to be it's just going to be more difficult for us to get comfortable. There's just still a lot of uncertainty. There's just still a lot of uncertainty out there, and it would just take us a lot of time to try to get comfortable with companies with exposure to that.
Okay. And one last question before we open it up. So given that you're seeing a bunch of your portfolio companies out there, we talked about like the work from home type flux, things like that.
Yep.
Is there any opinions that you feel like are emerging on the work environment front on what people are thinking is the right thing to do, or just trends that you're seeing?
I'd say the most common trend that we're seeing across portfolio companies, as well as other companies that we're talking to, is really some form of a hybrid model. Okay. We've had CEOs that were huge proponents, for obvious reasons, of having folks in the office 5 days a week. The reality is not everyone's going to get comfortable with that. We've also had CEOs that are okay with everyone working remotely, but then especially for junior people that are trying to move up in their career, they're getting less exposure to middle management, less exposure to senior management. That's not ideal either. So it feels like, at least with what we're seeing, there's a convergence in some form of a hybrid model. And maybe it's 3 days a week, maybe it's 2 days a week, but really some flexibility out there so that people can get people can get comfortable, not just existing employees, but also new recruits, because the reality is recruits are asking for that. So some, if you rewind a year ago, I'd say there were still a lot, especially a lot of younger people that demanded to work from home and had zero desire to go into the office. We saw that a few times with our portfolio companies. I think given all of the layoffs that have happened, that attitude has changed. And so people are now more open to a hybrid environment. And then those that were adamantly against going back into the office have become a bit more flexible. So I think we're seeing people from sort of both ends of the spectrum realize that the new world is probably going to be a hybrid world. And then when you look at some of the real estate that's out there, especially here in Austin with the commercial buildings, you might have a commercial building that is 98% occupied. But the reality is it still feels like there's only half the people because everyone's moving to a hybrid model.
Right. I am getting a lot of interest in people talking about what their labor portfolio looks like in terms of, you'll have full-time employees, you'll have part-time employees, you'll have contractors, you'll have gig workers, you'll have partners, and what types of work best fits into those buckets. And then, if you turn it 90 degrees, what are the types of people that are actually wanting to do those things? So, I think that we still got a lot to figure out in that area.
Oh yeah, absolutely. And it's probably just gonna be something that evolves over time.
Right. All right. That was awesome.